This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back to Macro Analytics.
Morning, Gord.
Been an exciting time, not only here in Boston, but overall in the markets, and specifically in the gold market. So I really thought we should talk about gold here this morning. I'm sure a lot of our listeners are well aware of what's been happening in the market, but maybe not to the detail that we've had a chance to really see for some of us who have a little bit more time. You know, John, this is a 7 sigma event, and I spent a long time, part of my career, doing things in manufacturing called 6 sigma. And this is a pretty rare event when you get 7 sigma. And to put it into perspective, 7 sigma is the equivalent of you meeting on any given day somebody that's 7'7". That's my rule, 7'7". 7 sigma is 7'7". When was the last time you met somebody that was 7'7", John?
I don't know if I ever have, which is kind of consistent with the hundreds of years gap between times for something that unlikely.
How rare this is, you know, and I've been to a few Celtic games, and even there it's pretty rare. Question is, what would cause a 7 sigma event? And so I know, John, you brought some slides here that has the timeline. I thought we'd just kick it off with a timeline and then maybe bridge into some of the other charts we have.
Here's what happened, or at least some of what happened. Over the past few months, a lot more people were demanding physical gold and silver from coin dealers or from the big metal exchanges where people could convert futures contracts into physical and ask for delivery. And the inventories on the metals exchanges were starting to really plunge. It was looking like, should that trend continue, the big exchanges were just a few months away from having to default. In other words, not having the metal on hand when the holder of a long futures contract came and wanted delivery. And they would have had to offer just cash instead, which would have been catastrophic for their reputations and for the precious metals paper markets. In other words, futures would no longer have been seen as legitimate instruments because they actually couldn't deliver the commodity that they called for.
John, I was tracking the COMEX market, and it's at, decade-long lows in inventory. It's like down 17% this year. And the last I had seen, they had like less than 290 tons of physical in inventories. And with demand increasing, there was a problem.
Yeah, that's really not very much in the scheme of things when you consider that there's maybe 100 times that much out there in paper. So if just 1 or 2% of the futures contracts that could call for the delivery of gold and silver actually did, that would wipe out the inventories in these exchanges and force them to default. So something had to be done here because this trend was accelerating and it was imminent. You know, it wasn't something that was 5 years out. This was months away from happening. And so basically, what did happen, what we know happened, is that a few very big players in this market went very short. They basically placed bets in the market that precious metals prices would go down. As you can see in the chart that's up now, the concentration of short positions in gold and silver dwarf anything else out there. You know, there are no other major markets where this kind of concentration is allowed to happen and ever does happen. So something big was about to happen just based on this chart, and then something did happen.
And not a lot of players. The major bullion banks.
Yeah, just a handful of players. Now, everyone believes that J.P. Morgan Chase is the ringleader here. And so, assuming that's the case, then you probably got Goldman Sachs and Morgan Stanley and a couple of others in there. So just the big players that are really proxies for the world's central banks in these markets. And what seems to happen over time is that the central banks will lease their gold to the bullion banks, the J.P. Morgan Chases, who will then dump that gold on the market and in that way depress the price of gold, leaving the central banks with less gold in their vaults than they claim to have, and something called gold receivables on their balance sheet, which they lump in with actual physical gold to come up with the total number. And that's what they report as their gold holdings. But a lot of that is already lent into the market, and it shows up in these massive short positions that the bullion banks have accumulated. But anyhow, that's a digression from what happened here.
So here we have huge numbers of shorts. We've got a shortage of physical at the COMEX. Something's got to be done about this or it's going to blow up. And then we start getting all these news announcements coming out, right?
Yeah. So if you go to the next chart, we show the news announcements that took place. First, on Wednesday the 10th of April, Goldman Sachs issued an advisory saying short gold at $1,600 an ounce. The very next day, the New York Times comes out with an article titled "Gold, Long a Secure Investment, Loses Its Luster," where they quote George Soros as saying that gold is no longer a safe haven in times of trouble, and you should sell your gold. And then about this same time, it became known, or at least rumored, that Cyprus, a small Eurozone country that was having financial trouble and was being bailed out, was going to be forced to sell its gold holdings to pay off its debts to the European Union. And that if they were forced to do that, it wouldn't be long before Italy, Portugal, and Spain might have to follow suit. So all of a sudden, you've got this massive new potential supply of gold on the market that wasn't there yet, but that could come. And then the big futures players began going seriously short. You know, they were already short, and then they went dramatically more short. They started dumping huge amounts of gold and silver on the market, which is standard practice. You know, they do this over and over again, where they push the market down using futures to trigger sell orders among technical hedge funds that are just watching price movements, which then trigger margin calls, which push the price down even further, which allow the big guys to buy back their positions at a profit. You know, this is something they do all the time. This time they did it on an unprecedented scale, just beyond anything that's ever been seen before. This past Monday, there was an overhang of potential margin calls because of the price movements on Friday. And so the big players pushed the gold and silver markets down even further, triggered all these margin calls, and forced massive new selling into the market, which caused gold and silver to fall about as much as they've ever fallen in one day. So you had the biggest bloodbath in precious metals ever. And apparently an engineered move. It looked like this was just planned and executed. And then it stopped. You know, no more massive futures being dumped on the market, and now things are kind of stable in precious metals. They've been up for the last couple of days, and are kind of sitting right at yesterday's level today as we speak.
John, they dumped 400 tons, which is 15% of the annual production in 2 hours. So they dumped 100 tons on the market, which drove it down, and right through the stop losses. And just as it was trying to find a bottom, they dropped another 300 tons. And they actually did 300 tons in 30 minutes. Now, if you're trying to sell 400 tons, would you sell it that quick and actually at a weak time in the market when there was low volumes? That's the optimal way of getting the worst price possible, is it not?
Oh yeah, this clearly wasn't a big player trying to move some gold and get the best price for it. This was clearly aimed at just knocking the market down.
This wasn't even subtle. And a lot of times there's arguments that come back on this. This was complete and total manipulation moving the market down. But I think it was so blatant. It also sent a message out there that says, just try us again, because it clearly demonstrates the power to do this and to knock the markets down. And, who's got 400 tons of gold? Well, the answer is nobody who's willing to sell it, because the strong hands, and strong hands I define as people who pay cash, take physical, and aren't leveraged. That's people like the Russia, China, the other non-fiat currency cartel members who are taking physical. But the ones who, and move it from the weak hands, which I call the retail on margin, dealing in GLDs or their speculative futures. What they were doing, the selling wasn't physical. They were selling naked shorts. This was a massive naked short exercise in my mind. And the only people that can sell this level of naked shorts are really the banks. They don't have to post any collateral. It's literally outright counterfeiting, is it not?
Yeah, this had nothing to do with physical metal moving around out there. This was strictly guys playing games with paper, completely disconnected from anything in the real world. So it's like a government printing press. It's infinite. You can name any number you want to and then just press a button and then the deal is done. And it happens on a scale that swamps anybody else who's playing in that market, so the price moves in the direction that the big players want it to.
They've been able to control price in many ways because what's happened is players like JP Morgan and them, and I don't mean to pick on them specifically, but using high-frequency trading techniques now, they can set the price where they want. They can start moving it through these stops very, very quickly. And if you've got unlimited shorts behind you, you've got tremendous control. So what I see happened here, threefold. One, somebody made a fortune, obviously, on the shorts here and driving the market down. Two, they've sent a message out to the world, beware if you're going to start buying gold and getting into gold. So there's a real fear that's put out there, which holds the euphoria of gold going too high too fast. We start printing. And also, additionally, it's got a price now that allows the shortage of inventory in the physical to be replenished at lower prices to take it off the weak hands. A lot of things are being accomplished, and personal opinion, I don't think it's finished yet.
Clearly, there were a lot of, as you said, messages in this, and one of them was, don't go aggressively long precious metals because we will smack it down anytime we feel like it, and do not use leverage to speculate in precious metals, at least on the long side, because we can clean you out anytime we feel like it. And that's a pretty clearly received message, I think, now, because it's true. These markets can be crushed at the whim of a few big players, so you don't bet against them. If you're a trader, if you're trying to play short-term moves in precious metals, it's not a market that you can really understand because it moves according to the whims of a trading desk that you're not part of. But I don't think they succeeded in scaring up a lot of new physical supply based on what's happening in the physical market, because instead of a lot of panic selling, which is something that you might expect when the market drops this dramatically, you got panic buying. Most coin dealers report that they can't keep inventory in stock now. They've got people lined up around the corner coming in and willing to buy pretty much any kind of silver coin or gold coin or silver bar or whatever that is in stock right now. And at the same time, you've got central banks who are still buying on a vast scale. China is basically sucking up all the gold that's available out there. They look like they're doing dollar cost averaging, where they buy more when prices are low. So they're committing the same number of dollars from their foreign exchange reserves month after month after month, or quarter after quarter. It's a little choppy month to month, but they're buying even more physical gold now, importing more through Hong Kong than they were 6 months ago. Which implies they're not scared off by falling prices in the short run. They like this because it allows them to buy more, because their long-term goal is to accumulate as much as possible. And it looks like small investors have gotten this message, and that they're behaving in the same way, based on the reports from coin dealers. So what these guys who are playing games in the paper market may have succeeded in doing is creating even more physical demand, which is sucking up more of the inventory that's out there and creating an even bigger crisis for themselves in the future. Because when inventories start to drop again, as they inevitably will on the big metals exchanges, there's going to be a lot less physical available out there to replenish those inventories, because people have learned that when prices go down, it's cheaper and you buy more. And so they've created the potential for an even bigger crisis out there in the not too distant future.
Yeah, that's, John, exactly why I don't think this is quite over yet. Right around the world, people react. You mentioned China, but India, people were just rushing in to buy gold. This was the opportunity they've been waiting for. I was monitoring this prior to it, and there was a tremendous amount of retail coming in and actually selling gold. They were worried about it dropping. This is going back to a lot of the discussion over the last 60 days. The reaction has been, now's my opportunity, and exactly what you said has begun. The question will be how hard gold physical actually starts to rise and whether it is mirrored in the paper price. My sense, John, is we're going to get a slow grinding rebound in here, but I don't think these boys are finished taking the scare out of the market. Personal opinion, I think there's one more kick at the can, in our technical charts that I spent a fair bit of time on Saturday with Andrew that are available on the site. Going through the technical charts will show you what I'm referring to as a fairly good possibility. And it's something that goes out over 90 days. It's a period here. So it's trying to take some of the euphoria out of the gold, trying to take the speculative longs to reduce the degree of speculative longs, not so much just the retail end of it. There's clearly another round of significant monetary expansion on balance sheets that's coming. This will allow it to happen without gold suddenly going parabolic, because as we've talked about many times, it's a direct competitor to the fiat currency.
So you see another smackdown
I do, John.
in May.
Not as violent as this, but I do see, especially in the technicals, which are showing very clear A, B, C, D, E patterns, which are termination patterns. And I have up here a chart that one of them that shows partial of the analysis. And it ties together very, very well, because even the points of driving these down found support at key points. Gold and the precious metals are all the commodities are driven very tightly with the technicals and the technical analysis. And so when I see it staying in very close patterns, even when it makes a move, as you see in this chart, from one ring down to the other, which is dramatic, it's still held very tight at certain levels. So we see it rising up on this what we call a D wave before we have one more down to a whole series of convergence. That could change, can change very dramatically, because up until recently, John, we were looking at something a little different, and I have that chart up here now, and it was a wedge, and that wedge was showing a consolidation pattern, and it was a flat-bottomed wedge in a triangle in a classic, but we just broke right through it. So, but that didn't mean the overall larger pattern had been destroyed. It just mean that we had changed the consolidation. Because to me, this is what this is. This is a corrective consolidation in an upward trending market from a technical perspective.
Two thoughts. One is blowing up a second bomb after the first goes off, but giving people time to come back to start digging through the rubble and stuff, and having the second bomb go off is a very standard terrorist technique. And that, what you're talking about, another smackdown, if it comes, would be the financial equivalent to that, where they let the dust clear a little bit, they let us start to think things are okay, and then they hit it again, and knock gold and silver down one more time. And that would be logical from the point of view of the guys manipulating this market. So it shouldn't be surprising at all if it happens.
If this was just business as usual, normal trading patterns, it doesn't often work that way. But when you're manipulated and you're practiced, as we might suspect is going on here, it's a classic way of doing it, because what you end up doing is you end up putting the fear of it happening again in people's mind that stays with them for a longer period of time. So it allows a 6 or 12 month holding down of gold because of this fear that's been built up, and it certainly stops those margining and leveraging, those weak hands. And that's what they want to get out. They want to stop the amount of people pushing margin and leveraging it up.
And the other thing is that we really don't need another aggressive manipulation for something like this to turn out to be true, because there's so many deflationary shocks out there waiting to happen right now, because the global economy is slowing down. And despite all the money that these guys have pumped into the system over the last few years, we're not getting a boom in the U.S. In fact, it looks like GDP is kind of flattening out based on a lot of the most recent indicators. And Japan hasn't started to pick back up yet, despite the fact that their interest rates are minuscule, and the central bank is beginning to do a doubling of its reserves. Europe is falling apart. So it could be that for the next few months or maybe longer, the dominant fear is that the global economy is tipping back into recession, which would be very deflationary and which just by itself could be bad for precious metals prices in the short run.
I think your reading is absolutely right on, John.
Yeah.
I think silver's got significant weakness in it. We're really starting to push some lows because it has got an industrial element to it besides a monetary element. Look at what's happening with copper right now. And it's a strong indicator of economic activity. And of course, we've just seen IMF take down global forecast. OECD is showing contraction. We definitely have a slowing industrial that's accelerating. Some of the Goldman numbers, they've just moved their recovery out from 2013 to 2014. That is now coming into the market. All the macro indicators are starting to read that. That'll unfold over the next 90 days. And I think gold itself will get sucked along with that deflationary scare. So the next smackdown may not have to be by somebody dumping 400 tons. There may be it's under its own weight. It may be able to take down. They may have killed the momentum. They may be hoping for that, and maybe with a little nudge here or there too.
Mm-hmm. But then at that point, you get all the governments reacting, as they always do to something like this, with even more massive money creation and tax cuts and increased spending. And
I think that's the bigger point.
Yeah.
I think that this is a big element of this is going to be to create the smokescreen that allow the governments or the central banks to take this next step of outright monetization. Because clearly, right now, we're in the throes of giving up on austerity around the world. Even the IMF is out now poo-pooing it, putting pressure on Britain to back away from austerity. They're the only ones talking about it. And a few months ago, IMF was screaming that Japan and Spain were unstable in terms of their debt. Now IMF's current report, they're saying that Japan's going to be the growth model going forward because of this amount of spending. I mean, talk about 180-degree shifts. So they're allowing the central banks to have the opportunity with this weakening and the smokescreen for the politicians to start printing again and get out from under this austerity.
Yeah, we've seen a political process in the last few years of the inflationists gaining an upper hand. For instance, Japan, that they ran their last election on monetary policy, which is something you really don't see very much in the modern world. And the inflationists won. The guy who said, we're going to take over the Bank of Japan and we're going to insist that it generate inflation of 2% going forward. And that's what they're trying to do right now. Let there be another tip back into recession in the U.S., and you'll see the Paul Krugman, Alan Greenspan-ish kind of idea come to the forefront, and where the doves basically win at the Fed. And we just let it all hang out, and we start monetizing all our debt, and we go back to running huge deficits and not worrying about trying to control the deficit at the federal level. And so the inflationists will win. And see, at that point, then we're back in 2010, with aggressive monetary expansion everywhere you look, and precious metals going through the roof, and we're back in global reflation. But getting there, you need a crisis. You need another scare to push the austerity guys completely off the field and open it completely to the inflationists. And that's what we could see in the coming year.
I personally believe it's within the next 6 months. We will be flat out into the next stage by September of outright monetization. Because the only thing that stops complete monetization, John, is you completely destroy your currencies. But if you're all doing it, one currency goes down, somebody's got to go up. But if there's no place to go and it's coordinated, which they call a cartel when you coordinate it, you can do it. And I think right now they believe they can do it. They can do it together because there's no other place to go.
Mm-hmm.
The people that aren't in a cartel, remembering, and I've said this many times, 90% of the world's trading is done in 4 currencies. And those currencies are all in the full-out debasement. So who's your option? Well, if you're not in the cartel and you're China and you're Russia, the BRIC countries, Brazil, you're just taking it in the ear right now. So they're looking at alternatives, and you see China opening the, trading hubs, etc. I mean, even they were going to do them in Britain, and now France wants to be a trading hub. So even the members of the cartel are worried about their own position versus just the overall position.
Yeah, it's crucial to understand that the reason that we've been able to take on the kinds of debts we've taken on is because everybody in the world wants dollars. Because the dollar is the main currency for international trade. And let that end. Let China and Russia start trading between themselves in their own currencies, and let that spread to Brazil and to a lot of the other big Asian countries. And all of a sudden, the dollar won't be as necessary as it used to be, and we won't have the ability to keep on borrowing the way we have been. And at that point, the game ends. And we're seeing signs that the global economy is moving in that direction. So the question becomes, when does it become apparent to everybody? When do we figure out that the dollar isn't the world's reserve currency anymore, that it's just one of 4 or 5 different currencies that you can trade in very efficiently, and it's one of the worst run of that bunch? And at that point, the game is over. And when it happens, it'll happen very quickly. As we've seen lately, markets can change psychologically on a dime. You can, one week it's one way, the next week it's a completely different way. And that's liable to happen to the dollar in the not too distant future, because the fundamentals all point that way. Now, when we are worried about a coming recession in the coming year, and we just open the monetary floodgates, that might be the trigger. That might be the thing that causes everybody to reevaluate the dollar, and then it's over. The last 30 years will be like they never happened, and we will become a third world country in a lot of ways, having to live within its means and having to cut spending or debase its currency really overtly in order just to keep going.
Yeah, when it happens, John, you correctly point out, it's like hyperinflation. It happens literally within weeks, and it's violent. And hyperinflation, as I've talked about many times, is a currency event, and it's the lack of confidence in the currency. So the moment people realize that the United States dollar itself is truly under threat, and it is right now, it's just not recognized, and that is the $6 trillion US dollars that are out there in the reserve around the world are no longer needed to the same degree. And we've fallen from 72% down towards just north of 60% falling. And when you, even a percentage point or two, well, you're talking $100 billion coming back to the United States at increasing rates. That's called hyperinflation, John. Mm-hmm. And I say that in terms of dollars coming back. And that's a fact, because the United States is no longer an exporter. The petrodollar is under threat right now. And these are grinding along, and people are beginning to recognize that more and more. And the moment there's an alternative currency, and look at the meeting we just had with the BRIC countries in Africa, and they're talking about an industrial bank, they're talking about pools, they're looking, and they're all buying gold, they're looking at protecting themselves.
Yeah, so all the trends point towards something like that out there, and the
at some
question
point
is when. Because from China's point of view, I think they like the current world in the sense that it allows them to continue to generate trade surpluses and use the resulting foreign exchange reserves to buy more and more gold. So if they could keep this going for another 5 or 10 years, they would be able to accumulate another 1,000 tons per year, let's say, which is the kind of the pace they're on right now. And they'll end up with among the largest gold reserves in the world, and the ability to back the yuan with something tangible and turn it into the world's reserve currency overnight if they feel like it.
I think that's exactly what they want to do. But unfortunately, they've got this island just across the sea there, Japan. 20% of their exports are coming into China, and they're competitively devaluing their currency. I think the big conflict is between Japan and China. Mm-hmm. That's where the real battle is happening, and it's escalated. And China is threatened by the degree of this devaluation and debasement of the yen, and the degree at which they're going to take it. And this is going to impact China, who is already in a very tenuous position with its growth right now. And they're going to feel that. And they've threatened to retaliate. They don't want to. As you correctly point out, the longer this drags on, the better off they are. But once it starts to really impact their growth, then a devalued yen can do that. And they'll start to feel it. Because it's not just China. Japan's more competitive with South Korea, Taiwan, etc.
Currency wars are fascinating to watch, because the process keeps changing. One country will devalue, and then they'll start to feel the benefits of it. But those benefits come from their trading partners who are disadvantaged by one country that they trade with having a much lower currency and much cheaper stuff. So they are forced to devalue. And so it goes back and forth like that in kind of a race to the bottom. And right now, as you pointed out, Japan is the main country doing the devaluing. And the rest of the world has this conflict because Japan will implode if they don't do it. And nobody wants that. But if they do manage to force the yen way down versus the dollar and the euro and the yuan, that disadvantages the rest of us. All of a sudden, we see General Motors sales drop dramatically, and China sees a lot of their exports to Japan fall, and their trade surplus with Japan melt away and turn into a deficit. And those things aren't sustainable because the people in charge can't get reelected or can't maintain their legitimacy if they're seeing huge parts of their export industries be just blowtorched by changes in the currency market. So they have to retaliate. This is never ending.
The G20 meeting, they're caught in twixt and between. So they're all saying they don't want to have competitive devaluation. They don't want currency wars. But Japan's sitting at the meeting doing what they're already doing. They should eat up in Japan and lay down the law, but they don't. Now, why don't they? Well, the answer is they're trying to reignite the Japanese carry trade. All of a sudden, a weakening yen, you've got no downside on the risk, and you're borrowing money at zero or negative. Where's that money going? It's not being reinvested in Japan. It's flowing into Europe. It's flowing into the United States bond. It's flowing in anywhere where there's any better yield with no risk. So they're looking at this as a money spigot right now. So they're kind of tongue in cheek, but China sees this for what it is. Brazil does, Russia, etc.
Yeah.
I don't think it's going to end well. And as you correctly point out, it'll go on until it won't, and it'll be sudden. And I'm not saying it's imminent, but certainly we're below the event horizon on this one.
And the situation, because as we talk about this, we keep coming up with new twists and new reasons why this has to happen or that has to happen. It becomes so complicated that you basically get to pick the threads of this out, where we see these countries acting in a certain way because of this stimulus, when there are three other reasons why they can act a different way. And so there's no real way to know how this plays out, except that it'll be chaotic.
I don't even think you want to get into speculating, John, because it'll be some stupid politician will say the wrong thing. Some Lehman Brothers bank will fail because of counterparty, or it's a geopolitical event. Something will trigger it. It's like trees growing to the sky. You don't know when it's going to fall. You don't know whether it's going to be a butterfly, a breeze, or what, a poof, but you know the tree's going to fall. Mm-hmm. And because it's unstable. And we're moving into an era right now where we're now unstable. And all of these are symptoms of instability in a complex, unrobust kind of system. So, 6 months, 16 months, it's somewhat unimportant. The point is it's coming. And that should be enough to start preparing yourself in some ways. But the strong hands are buying. And I say strong hands, Russia, China, Brazil.
Mm-hmm. And individuals who buy gold and silver coins are strong hands too, because they're not going to, if the market drops by a few bucks, they're not going to dig them up out of their backyard and take them in and sell them. Once you own some gold and silver bullion, you tend to forget about it. You put it in the safe deposit box, or you hide it in somewhere on your property or whatever. And that's the last thing that you cash out when things get weird. So what we're doing with individuals showing up at coin dealers and buying up everything that they can buy and taking it home is we're taking that bullion off the market. So China is locking away huge amounts of gold. Individuals are locking away huge amounts of silver, and the physical is just drying up out there. And the longer this goes on, the less and less there will be, and the more and more unstable markets will become, because there won't be any physical backing up the paper. And there won't be anything there for delivery when futures contracts demand delivery. And we've created the conditions. Anyhow, in everything we're talking about, it always comes back to increasing complexity. We're creating conditions that are more and more unstable over time. And so the longer this goes on, as you said, the greater the propensity for some kind of catastrophic collapse becomes. And there's no way to know what the collapse will be or when it'll happen, but we know that it's coming as we progressively increase the complexity of the system.
John, we're way past our hard line on this, but this is something we'll talk about numbers of time this year. But enjoyed it. Any last comments you want to make?
No, I think we've covered it this time, Gordon. That you're right. We went over our normal time as we always do. There's always so much to talk about.
But I know we have so many listeners that are keenly interested in what's going on here, and I guess the best word of advice is don't panic.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.